If you've been watching this channel, you know how big a fan I am of options as a product. I've even gone on to call it the Swiss Army knife of financial instruments. You see, an important part of how options work is how they get priced. And some of you would have read or come across this term, the Black-Scholes options pricing formula. That's something which sits right at the heart of the way options get priced, moment to moment. And if you're an options trader, one way or the other, you end up dealing with it. Many years back, I went down the rabbit hole of trying to understand where this formula actually came from and what the backstory was. And it turned out to be a super fascinating story. One that actually starts with a Scottish botanist named Robert Brown way back in 1827 when he was looking through his microscope at pollen grains floating in water. From there, the story travels to Paris, where a French mathematician was trying to describe how prices move on the Paris Stock Exchange. And without knowing it, wrote down the math behind the exact pollen trembling thing for the very first time. Then the story goes to Switzerland, where a young man working as a clerk in a patent office doing physics on the side reached the same math from a completely different direction, chasing the question of whether atoms are even real. From there, the trail leads to America, where the man who finally cracks it isn't an economist at all, but a consultant with a physics background named Fischer Black. He teams up with two economists, Myron and Robert Merton, and together they bring it to a close. And the timing of it all is way too perfect. The formula reaches print in 1973, the very same year the world's first modern options exchange opens in Chicago. All of this a good 150 years from the time Robert Brown got curious about the floating pollen. And just about 3 decades ago, the Black-Scholes formula eventually reaches the shores of Mumbai, India in the year 2001 when the NSE launched Nifty Index options. Today, it's there on every trading app. Every time you look at an option price, it's right there. I'm your host Sandeep Rao, and that's what this episode is about. The story of the Black-Scholes option pricing formula. What it is and how it came into this world. So what exactly is the Black-Scholes formula? Simply put, it's a method to answer the question, what should an option cost today? Remember what an option is. It's the right but not the obligation to buy or sell something at a fixed price by a fixed date in future. The hardest part is the price. When you buy that right today, you have no idea how things are actually going to play out in the future. So what's a fair price to pay for it today? Now, our first instinct, and it was everyone's first instinct for decades, is that you would have to guess where the stock is going to go. If we knew for certain that Nifty was headed up, pricing a call option would be very easy. But of course, nobody knows that. And that's exactly where the formula does something very smart. Black-Scholes says you don't really need to know which way it's going to go. You only need to know how much it will likely move, what we call volatility. Think of it like insurance. When an insurance company prices your policy, they don't need to know whether your car specifically is going to crash. They just need to know the odds, how risky it is, how much could be lost, and how long the cover runs, and what money itself is worth over the stretch of the time, since a rupee later is worth less than a rupee today. The Black-Scholes formula works pretty much the same way. You need to feed in a few inputs. Today's price of the stock, the strike price you've chosen, how much time is left, and the going interest rate. Plus, the one thing that you have to estimate is how much the stock tends to swing. That is the volatility. Put all these things into the equation and out comes the fair price of the option. On a side note, if my memory serves me right, Zerodha was the first broker to make an online Black-Scholes option pricing calculator available for free. It still exists and works perfectly. So yes, that's really what Black-Scholes is. An algorithm that takes a few inputs and turns it into a fair value of an option. In reality, the math runs moment to moment to make sure the options are priced correctly all through market hours. Now that we know what Black-Scholes formula is used for, let's get to its backstory, which is the most interesting bit. The story actually starts a good 200 years back in London. A botanist by the name Robert Brown noticed pollen moving in a jittery manner in water when he was looking at it through his microscope. He tried dust, he tried ground up stone, everything was moving in a jittery manner. He wondered, if the thing is not alive, then why is it moving? The question sat unanswered for decades, and then it got answered 3 times over in 3 completely different corners of science by men who, for most part, had never heard of one another. The first was Louis Bachelier, a French mathematician who in 1900 was trying to describe how prices moved on the Paris Stock Exchange. And to do it, he wrote down for the very first time the mathematics of pure random motion, the math that could be used to describe the movement of the same pollen Brown had seen through his microscope. Bachelier saw it in the ticker though. His thesis was ignored and left to gather dust for a good 50 years. Then came Albert Einstein. In 1905, working as a clerk in a Swiss patent office, Einstein was solving for a bigger question. Do atoms actually exist? And the mathematics he arrived at to answer it turned out to be very similar to what Bachelier came up with. Einstein showed that Brown's trembling pollen was trembling because it was battered by billions of invisible water molecules, and turned it into one of the first hard proofs that molecules are real. He had never heard of Bachelier though. The third person to work on the same problem was Norbert Wiener, an American mathematician in 1923, who finally proved that this random motion was a real, well-defined mathematical phenomena, something neither Bachelier nor Einstein had explained. And in doing so revealed that the drifting stock price and the trembling pollen grain can be explained by the exact same equation. The math of it is still named after him, the Wiener process. The Wiener process is actually the mathematical formalization of the physical Brownian motion, which was named after what Robert Brown had observed. From there, the story moves to an American statistician, at that time working at the University of Chicago, by the name Jimmy Savage. Sometime in mid-1950s, Savage was digging through some old mathematics when he stumbled onto a book by this long-forgotten Frenchman, Bachelier. He was quite intrigued that someone half a century earlier had worked out a math of random motion and pointed it straight at financial markets, and nobody in economics seems to have any idea that he existed. So Savage did something very smart. He scribbled out a handful of postcards to economists he knew, asking more or less, do any of you know this old French work on speculation? Most of those postcards led nowhere, but one of them landed on the desk of Paul Samuelson at MIT, one of the most influential economists of the century, who's contributed to everything from efficient market hypothesis all the way to the idea of index funds. So Samuelson went looking for the book Savage had mentioned but couldn't find it. But instead, he could dig up Bachelier's original 1900 dissertation. And reading it, he realized Bachelier had been decades ahead of everyone. But there's one thing that Samuelson did. He fixed the flaw that had been sitting in Bachelier's math for half a century. Bachelier had let the prices wander like a particle of a pollen, which meant in Bachelier's model, a price could drift below zero into negatives. But a stock can't go negative. The worst it can do is go to zero and stop. So Samuelson made one crucial change. Instead of the price itself doing the random walk, he had the percentage change in the price do it, which keeps a stock's value positive no matter how far it falls. Samuelson was on this problem all through 1955 for the next decade. Meanwhile, at Yale, a young doctoral student named Case Sprenkle picked the exact same problem Bachelier had left behind for his thesis. What is an option actually worth? By 1960, at the age of 26, he had the answer written down, and a year later he published it. His approach was quite logical. He looked at two key inputs. What is this thing likely to be worth when it expires, and what is the future payoff worth today? The solution was to work out the average outcome, then discount it back to the present. Now, Sprenkle's solution was so good that a decade later it would become the thing Black-Scholes would build on. I think it would be fair to call it some sort of a foundation on which others built on. But the foundation by itself is never a finished building, and Sprenkle's solution had a crack in it. To actually use this formula, you need to feed it the two numbers. The first was a stock's expected return, and the second was the perceived risk in it. so that one could back calculate the discount rate, greater the discount for greater risk. And here was the problem: nobody can measure any of those two variables. The first is a guess about the future, and the second is a feeling buried inside the heads of millions of investors. Now, Sprenkle knew it too. He went to the market data, tried to pull both the numbers out, and in the end admitted he couldn't. And so there it sat, and Sprenkle wasn't alone either. Through the 1960s, a handful of sharpest economists alive, Samuelson among them, tried to solve the very same problem and hit the very same wall. They all had roughly the same formula, and all they needed was those two impossible numbers. Now the year is 1965, and here comes a man who had nothing to do with finance. Fischer Black, who had just finished his PhD at Harvard in applied mathematics, and even that he had arrived at sideways, as he had started in physics, drifted into artificial intelligence and data, and generally resisted spending too long on any one thing. He was a brilliant, restless, and a little difficult person to deal with. So how does a man like that end up with solving option pricing? Well, through a job and a mentor. Black actually took a position at a Boston consulting firm called Arthur D. Little, and there he met a colleague named Jack Traynor. Traynor was working on an idea that would become one of the pillars of modern finance: a way of describing how any risky asset ought to be priced based purely on its risk. Today we call it the Capital Asset Pricing Model, CAPM in short, something I have referred to in many of my earlier episodes as well. Black was captivated by the elegance of it. Here was a clean, almost physical law for how the financial world balances risk against return. Black was so fascinated by the version of CAPM developed by Traynor that he started applying this pricing model to everything he could find. And one of the things he turned it to was a strange little instrument that had defeated everyone before him, the option. Now, applying CAPM to a stock is one thing, but Black wanted to apply it to the option on that stock. And that's where it got interesting. His reasoning went something like this: an option's value depends on the stock underneath it. So as the stock price moves a little, the option moves too. So in a way, you can pin that down. And if you can pin that down, then you can build a combination. Hold the stock and at the same time hold a matching amount of options against it, balanced so that they move in perfect opposition. So whatever the stock does, the option undoes. A tiny move up, a tiny move down, it doesn't matter. The combination doesn't move at all. And here is that light bulb moment, super fascinating one. So if you have built a combination that carries no risk at all, one that won't hurt you whichever way the stock moves, then by the logic of CAPM, that combination should earn only the risk-free rate of interest, nothing more, because there is no risk left in it. That one idea was nothing short of revolutionary. Every person before Black had been trying to guess where the stock was heading and how much investors feared risk. Black just made both those questions irrelevant. If the risk is hedged away to nothing, then it doesn't matter where the stock is going, and it doesn't matter how anyone feels about the risk. The two impossible numbers are not needed at all anymore. Black took that idea and wrote it down as an equation. And here's where he got stuck. He simply wasn't good at solving differential equations. But there's a deeper irony here. When Black applied the CAPM moment to moment and wrote down how the options value had to change as the stock moved and time ticked down, the equation he ended up had the same skeleton as the heat equation, the physics equation which describes how warmth spreads through a metal bar. Temperature at a point over time became option value at a price over time. The same diffusion logic. Black had studied physics as an undergraduate and still couldn't recognize it. So he set the problem aside and moved on for a couple of years. Then in 1969, Black, who had by now left Arthur D. Little and set up his own consulting firm, was pulled into the same Wells Fargo project as Myron, a newly minted PhD from Chicago. Scholes was teaching at MIT at that time and in a department led by none other than Paul Samuelson, and Robert Merton happened to be one of Samuelson's students. So Boston was where all of this was happening. This was the moment when all four of these minds were working on the same problem. Black brought the idea of applying CAPM to warrants, products similar to options. Scholes focused on testing the model against how the real world actually prices options. And one of the biggest contributions came from Robert Merton. He showed that if you rebalance and hedge continuously, the position becomes perfectly riskless, which let the formula be derived from pure no arbitrage, without leaning on CAPM or any equilibrium assumption at all. Black and Scholes thought it was the most general and elegant derivation and used it in the final version of their paper. Merton's continuous time pricing theory extended the framework and strengthened its whole foundation. Interestingly, it was Merton who held his own contribution back, wanting Black and Scholes to publish first. And that's perhaps why it's always been known as Black and Scholes model rather than Black, Scholes and Merton. One tiny tidbit to put their ages in perspective. At the time they were working together, Black was 31, Scholes was 28 and Merton was just about 25. 24 years later, in 1997, the Nobel Prize would go to this work. By then, Fischer Black had died. Close to 10 people across more than 150 years each added a bit to what finally became Black-Scholes Merton option pricing model. A botanist who never touched a stock perhaps, a Frenchman whose theses gathered dust for 50 long years, a physicist chasing atoms, a statistician with a stack of postcards, none of them knew that their contributions would end up solving option pricing. And that's the beauty of inventions like these. The threads only join in hindsight. Nobody single-handedly set out to write a formula that would sit inside every option price on earth. They just tried to solve a problem that was in front of them, and someday 3 people came together and tied it all together. So the next time you pull up an option chain and glance at the price, remember you're looking at 150 years of accident, curiosity, obsession and brilliance compressed into a single number. I hope you found this episode useful and interesting. If you have any questions, feel free to drop them in the comments. I'll be happy to respond. And don't forget to subscribe if you haven't so far. Till then, take care and trade safe. I'll be back soon with the next one.